So welcome to today's webinar on cryptocurrencies, risk, opportunities, and challenges. Before I actually get started, I just want to go through and, I wish to begin by acknowledging the Wurundjeri people of the Kulin Nations, traditional owners of the land from which I'm presenting from today. I pay my respects to the local people for allowing us to conduct our gathering virtually on their lands and to their elders past, present, and future. So my name is Peter Vuong, and I'll be moderating today's session, meaning I'll try to make sure that we all finish on time, including myself. I'm joined by my colleagues, Karen Powell, who's a senior lecturer of tax in Deakin's Law School, and we've got Adam Steen, who's a professor of practice within the Department of Accounting and Financial Planning. Now, if you do have any questions along the way, feel free to use the Q&A feature on Zoom, and the panelists will review the questions towards the end, and we'll sort of go through as many of those questions as we can. Please do note the session is being recorded as well. And for those, I suppose, who want a CPD certificate, there'll be a link that's going to be posted in the chat somewhere towards the end of the session or the webinar. So keep an eye out on that. Effectively, if you follow that link, there'll be some multiple choice questions that you can do. And if you successfully complete those questions, you'll be sent a certificate for CPD. All right. So just a bit about myself, I suppose, before I jump into it, so you can sort of see what my background is. I have a doctorate in banking and finance. I suppose one of the lesser known things about myself, though, is I actually have a degree in mathematics as well. And in the past, I used to think that it was just a degree that sort of collected dust. My degree in mathematics was actually specializing in number theory. And so it was very hard for me at the time to sort of figure out how that sort of tied together, but it was what was interesting me at the time. I never thought it would be quite useful in my, particular career choice, but lo and behold, here I am. It's funny how things work out. So I suppose before I get started, imagine, if you will, someone walks to you on the street, right, and says, there's this great company out there. You can invest into it today for pennies on the dime, right? And in a couple of years' time, this company is going to make it big. It's going to be worth $100,000 per share. It's going to turn you rich. Most people would be quite skeptical. I suppose some rational people might go forth and inquire about the company or this investment itself. What does it do? How do they make money? How does it work? Et cetera, et cetera. But I think for me, and with crypto, I find that a lot of regular people, this logic seems to get thrown out the window, right? And I suppose one of my goals here today is really, educating the community and the audience, I suppose, in terms of what is cryptocurrency and crypto assets, and sort of how does the technology work. By hopefully giving you the information, you can form your own opinions as to whether or not it's a worthwhile venture. Okay. Now, just as I'm going through the content, I've tried to keep, due to time constraints, of course, I've tried to keep things quite high level. And so from time to time, I might use the technically correct terms, but sometimes I find that it gives a better understanding. Okay. Don't hold that against me. All right. So underlying all of cryptocurrencies and crypto assets, I suppose, is technology that's often referred to as blockchain, right? And in a lot of the slides I'm going to go through, I'm going to really use Bitcoin as an example to explain how this technology works. Bitcoin, I suppose, is probably the most apt one to talk about, given its market capitalization and its popularity, I suppose. So first and foremost, Bitcoin, like many other cryptocurrencies or crypto assets, are a digital asset or digital currency. It's digital in the sense that, contrary to the picture that you can see on the screen, it doesn't actually have a physical form, right? I say it's a currency, although that's somewhat debatable as well. But it's a currency in the loose sense that the intentions behind Bitcoin itself is to act as a mechanism to facilitate transactions, okay, to buy and sell goods and services. Now, whether or not that can happen, again, is debatable, and we'll get to that. I suppose what's important here is that Bitcoin, like many other cryptocurrencies or crypto assets, is that it's uncentralized, right? There often as well is some sort of cryptographic technology or measure that's used to encrypt or provide some anonymity, right? And that all cryptocurrencies and crypto assets rely on what's called blockchain technology, okay? So what is the value proposition here? And why do people bother with crypto, right? I suppose one of the main arguments for cryptocurrency or crypto assets is that, in traditional financial systems, there's always a central authority that controls the record or information. Okay, it doesn't have to always be with money. And so, for example, how do you tell if something's real or fake if you want to verify something, right? Oftentimes you would approach some sort of central authority. For example, if you're in Victoria and you want to verify somebody's driver's license or car registration plate number, you would approach the central authority on that, and that would be Vic Roads or the DMV in the US, or whatever the authority might be. If you wanted to validate a birth or death certificate, well, then there are relevant authorities that you would go to validate this information. And these authorities, or this central authority, also has the power to issue this information and record and update this information. Okay. So effectively, when we want to verify something, we go to the central authority. Okay. In the case of money, we need a central authority to issue money. Typically, it's the central bank, in Australia's case, the Reserve Bank, issue money and also validate the money. And oftentimes we need to validate the money, of course, because we need to avoid what's known in economic terms, the double spend problem. How do I tell if a dollar is actually being spent and not being spent twice, and it's only being spent once? Okay. So I suppose with a decentralized system, which blockchain operates on, like I mentioned, with cryptocurrencies and crypto assets that operate on blockchain technology, oftentimes the information and the records are decentralized or uncentralized. I should probably use the right term, uncentralized, right? So in an uncentralized approach, or perhaps a distributed ledger approach, everyone who participates in the system has access to the same records and information, right? Whether there be transactional ledgers or there be some other information. And every participant partakes in the process of verifying the facts. Okay. Because the system or information is decentralized, again, one of the arguments for blockchain technology is that decentralization helps reduce the risk of corruption, fraud, and manipulation. As the saying goes, power corrupts, absolute power corrupts absolutely, right? So, it might seem absurd to some that a government authority may manipulate facts, but we've seen instances, or the example that oftentimes gets brought up is with the global financial crisis in 2008, where governments effectively rewrote the history of banks and the amount of debt they owed by quantitative easing, for example. Again, it's debatable whether that's a good or bad thing. The issue here, of course, or the fact of the matter is that the central authority could do so without the consensus of the public. Okay. In a decentralized system, when everyone's keeping track and verifying the facts, it's virtually impossible to change past transactions, right? In the case of money, money just can't be created out of nothing. I'm using the term money in a very loose sense. One other thing I probably should mention as well is that Bitcoin was, I suppose, one of the first implementations of blockchain technology that sort of removed the need for a central authority, or proposes the removal of the need of a central authority. And it's a record that's kept by everyone, right? All right. So while Bitcoin was one of the first implementations of blockchain technology that tries to solve this central authority problem, I suppose it's not just limited to money or transactions involving money. I suppose there are other cryptocurrencies and crypto assets out there that look at decentralizing other records and facts and information. For example, Ethereum, which you may have heard of, decentralizes contracts. You've got digital art through NFTs and whatnot as well. And so really, all of this decentralization works, and we can trust that it works because of what's been proposed on blockchain. So what exactly is blockchain? Because I keep mentioning it, and you've probably heard of the lingo before. Blockchain technology is actually not really new. Okay? What it does is it takes an existing set of technologies and ideas and puts them together in such a way that you don't need a central authority for the system to work. Okay? In its simplest view, blockchain technology really is just a set of rules or protocols that enable some sort of decentralized information to be verified and created. Okay. There are a number of elements that make this work, and we're going to go through them in the next couple of slides. But I suppose, imagine, if you will, we have a book, and on every page of this book, right, is a table, or let's call them a ledger. Okay. And at the bottom of every page, there's a summary, and that summary gets carried over to the next page every time you turn the page. Okay. That's essentially what blockchain does. In order for you to make any changes to future pages or future blocks, you sort of have to go back and rewrite the entire book because the summaries get carried forward. Now, I suppose if there are any accountants in the session, we already have this with modern day double entry accounting, right? Where historical records or ledgers are brought forward to subsequent ledgers of the next month. But really, in that particular idea or understanding, I suppose that we still have a central authority, somebody who can, one person or one group of people who control the flow of information and record keeping itself. Okay. So how would we do that in a, I suppose, public setting where everybody has the same equal access? All right. So the reason why I suppose it's called blockchain is effectively because all of these pages or all of these blocks where the information is recorded is linked together or chained together. Okay. Right. Some, I suppose, examples. I tried to come up with some examples of blockchain use cases. Decentralizing of information, whether it be contracts or information on records, land registry, vehicle registry, medical records, for example, supply chain issues. There's a whole host of applications for the technology itself. Interest of time, I won't go through all of it though. All right, so how does blockchain actually work? How do we create a system that allows the creation, verification, and updating of records by everybody? And how can we trust that those records are true? Okay. There are really 5 main elements for this to work. A peer-to-peer network in order to facilitate communication, some cryptography to ensure that messages being sent are indeed from the sender itself and no malicious third-party actor has come in to manipulate those records, a consensus algorithm, a reward, and then I'll talk about market adoption. All right. So again, keeping this quite high level, we need a peer-to-peer network in order to communicate and share data with each other remotely. Okay. This peer-to-peer network is simply a network of computers, and the computers on the network are known as nodes. Okay. What's important here is, and we already have this, we have the internet where we can send and receive information data, right? We have work intranets or networks at home, for example. So setting up a network isn't sufficient in order to create a blockchain. What's important here is that on a blockchain, in its proposal, the network of computers must have equal privileges. Okay, so every single computer or node in the network has equal access as every other computer system itself or every other person. So imagine your workplace or home network, right? If you imagine your workplace, oftentimes there are system administrators who have full access to all the data files and information, but most employees don't have the same level of access as system administrators. Imagine, if you will, every employee in your organization or company, right, had the exact same level of access as system administrators. Now imagine how that would work if one of the employees or one person had some malicious intent in terms of using that information. Okay. So to that end, a peer-to-peer network is not enough. We also require element number 2. Element number 2 is the cryptography element or aspect. So cryptography really is the art and practice of securing communication in the presence of a hostile environment, right? Textbook definition. Cryptography effectively allows a person to verify a message quite easily and prove the authenticity of a message, even when there are malicious users around, right? And we need this cryptography element really because of that first element. What I'm saying here is every computer is equally privileged, meaning that everybody has the same read rights and access to the data and can create the same data. But we need to be able to verify that a certain piece of information has flowed from or has been communicated from a particular party easily. So if we think about it, again, I don't want to delve too deeply into the technical aspects, but some food for thought. Imagine trying to send a message, a handwritten message to somebody else. How do you prove along the way, how do you prove that that message was written by yourself and that, that is a message that, that you intended and nothing has been added or amended or changed along the way? So again, cryptography is part of the solution. Element number 3. So now that we've got this communication aspect and we can secure the communication, we need a set of rules, I suppose, for blockchain to work. So every participant or node on the system in a particular blockchain, whether it's Bitcoin's blockchain or Ethereum's blockchain or whatever blockchain it might be, really there are a set of rules or a set of protocols that have to be followed. And that's what's referred to as the consensus algorithm. Okay. These set of rules or protocols are what we all agree to if we decide to participate in this network. We all agree that we will follow these rules when it comes to creating new records. Okay? In the case of blockchains, whenever we want to create a new block, we will follow these rules. There are many types of consensus algorithms: proof of work, proof of stake, proof of importance, proof of activity. The list sort of goes on. Generally speaking, with Bitcoin, for example, though, and I'll talk about this in a bit more detail, proof of work is what's used as the consensus algorithm. Okay. There are pros and cons to each of the consensus algorithms, but again, in the interest of time, I won't go through it. But regardless of I suppose, which protocol that's used in a blockchain, in order to run a decentralized system where everybody has equal access rights or equal privileges, you need a set of rules. Right? Otherwise, it's going to get quite messy quite quickly. Okay. So what is proof of work? Just in a nutshell, proof of work was something that was invented in the 2000s, early 2000s, and originally it was created to combat spam emails, to be honest. The idea is that with your email protocols, every time you send an email, your computer does a very simple calculation. It only takes a second and you don't actually even know it's happening, right? But you can imagine if someone's quite malicious and they're trying to send out millions of emails, that's going to be millions of seconds of computational time that the computer would have to run through. And so by doing these small calculations, you're demonstrating some proof of work, right? You're exhibiting work, and it's quite costly, this computational time. Okay. So with proof of work, the rule basically, or the set of protocols, generally speaking, states that in order for someone to earn the right to add a new page to the ledger or to the blockchain, you need to find a solution to a problem. Okay? You need to solve some mathematical problem. Okay? This requires the person or the node, the computer, to expend some computational power. And this is what people refer to when they talk about mining Bitcoins or mining cryptocurrencies. Okay? Essentially, when one person or one node finds a solution to the problem, they display this solution to the network, and they're basically displaying proof of work, right? They're basically making a statement that says, I've gone through and done all the calculation, and I've put in a lot of work into this to verify that I'm not mucking about, effectively. Okay. Now, I am running out of time, so I won't talk too much about the actual nature of how proof of work works, but just in a nutshell, Bitcoin's proof of work works on what's called a SHA-256 algorithm, right? So you can imagine a number with 256 digits along the way, a very big number, yeah? It's a mathematical problem, and the mathematical problem is scaled. So by changing some inputs, okay, you need to get the first n number of digits, so it could be 10 digits or 20 digits or 100 digits, to be 0. And that's the puzzle itself. Okay, this is a one-way function at the moment. There is no mathematical solution to it. If you did, you could basically break military grade encryption. The only way you could do this is by brute force and by trying different combinations of variations of inputs in order for you to get, let's say, 100 zeros in a row. By design, this puzzle can take extremely long amounts of time, but by design, the more people or computational power that's on the network, the harder the puzzles get. You can increase the difficulty by increasing the number of zeros required effectively. On average, by design, though, it takes about 10 minutes to solve a particular puzzle on the Bitcoin blockchain, and that's by design. So they make it harder or easier, depending on how much computational power there is. By design, it should take 10 minutes. All right, so element number 4, why do people go through all of this hassle? Well, there needs to be a reward, some sort of incentive. I suppose whoever writes the information or finds the blockchain gets to write the next block, right? Gets to record and verify the information. So oftentimes they'll pull transactions from a pool of transactions, put them into a block, process it and publish that out. And everybody can verify that new block is authentic before they continue on with mining. As a reward or incentive for you finding that block, you can add to your own balance a certain amount of Bitcoins, for example. And that's the reward for miners or people who try to solve this solution. This reward halves every 4 years or so. And so at the moment, it's set to about 6.25 Bitcoins per block. So every 10 minutes on average, somebody or a group of people out there gets 6.25 Bitcoins per 10 minutes. So you can work out the number there. I suppose the last part that I'll speak to, and then I'll pass it over to Adam, really is the market adoption, right? And this is the real value proposition, right? I could set up a blockchain today through a series of spreadsheets. I could email it out to everybody. Everybody could have the same read access rights. We could do it in a Google document, right? The issue, of course, is if I came up with Peter and Adam's crypto coin, whether or not that could be used to facilitate any real world transactions, right? And so the real question of Bitcoin's value proposition is how widely adopted would it be in the real economy, right? First real world transaction with Bitcoin was 10,000 Bitcoins to purchase two pizzas back in 2010. Obviously, a lot of cryptocurrencies, given its anonymity, that helps facilitate a lot of illegal activities. But in more recent years, rumors of other companies and organizations accepting Bitcoin. So it's really up to the individual to have a think about, the value proposition really depends on how much you believe people are willing to accept Bitcoin, for example, in this particular case, as a means of currency for goods and services. All right, so that's it all from me. I'm going to pass over to Adam.
Well, that's great. Thank you, Peter. One of the interesting things that Peter said, which was on that second last slide, was how Bitcoins can be created. And they're created through the process of mining, as many people know. So it's got one of the elements of currency, which is scarcity, i.e. there's a finite amount of Bitcoins. And because of that, it has an element of currency that traditional currencies that we use. But there are some really important differences, which I'll go through in a minute. My background very quickly is that, and my involvement in this is that for good or bad, in previous lives, I was an IT manager at a big company, which was part of the World Bank. I was involved in setting up the National Centre of Cybersecurity. I'm as it says there, I'm on a number of committees with the Society of Trust and Estate Practitioners, which is a worldwide body. And I'm one of the founding members of the Digital Asset Special Interest Group there. But I also did a PhD many years ago in finance, and my area of finance was on speculative bubbles and investment cycles, which I can talk to you a bit about now. So one of the issues that we have in, thanks, Peter. Next slide, thanks. One of the issues that we have, when people talk about Bitcoin, the main thing that we're talking about in the media these days is about investing in cryptocurrency, and Bitcoins in particular. from my perspective, and you can have, we can debate this, and I'm not the font of all knowledge, of course, but from my perspective, the things that occur to me when we're talking about making crypto as an investment, the lack of physical presence. And in my view, it's akin to speculation. It's essentially gambling. You're gambling on the value that people assign to something, and trying to profit from that, which is fair enough if that's what you want to do. As Peter said, there's no regulated market. Like other investments, there's no product disclosure statement, there's no prospectus. The lack of security is a worry too, where we know that to access, say, Bitcoin, you have to have your digital wallet. And in other words, a password and username to actually access your account. And of course, those details, if you keep them around your house or you keep them on the computer, of course they can be accessed and hacked. Extreme price fluctuations, as we've seen very recently in the price of various cryptocurrencies like Bitcoin. It's not a recognised medium of exchange, nor is it legal tender in any country apart from Ecuador. So if you're in Ecuador, yeah, okay, fair enough, that's okay. And the other thing is the retrieval and transference. How do you transfer it? Unless you leave clear instructions, unless you leave your digital wallet. We've had several cases now, of people with significant amounts of money invested in Bitcoin. They've passed away, and their next of kin, their estate, has not been able to find the details of their digital wallet. So there's some issues there. Thanks, Peter. If it looks too good to be true, it usually is. Now, I'm putting on my investment hat here, and I'll tell you a very quick story. You've probably seen this in the media. Gerald Cotton called himself the crypto king. So he set up this thing called Quadriga, which was a cryptocurrency exchange, which allowed people to buy various cryptocurrencies. So you could, email, set up an account online, and you could buy some cryptocurrencies. Okay. Cotton was the only person with the access to the digital wallets of all the investors, and it had $215 million in investors' Bitcoins. He went to India on a holiday and suddenly dropped dead. The death certificate was issued very quickly. There was no autopsy. And after his death, so-called death, after the announcement, users discovered that Cotton and his co-founder had a dubious past in setting up Ponzi schemes, money laundering, identity theft, and exit scams. My point is this: if things look too good to be true, they usually are. Thanks, Peter. Next one. And we can go back in history and look at things like, you can go back to the tulip bubble of the early 1600s in the Netherlands. And, people started buying tulip bulbs, the prices soared. And at their peak, a single tulip bulb sold for 10 times the annual income of a skilled craftsman. So if you think about a tradie today, what your plumber or your electrician's earning, a lot of money. In one trade, 5 hectares of land were exchanged for 2 bulbs. The prices peaked at 200 times their initial price. And it's a very famous quote from a journalist at the time, Charles Mackay, 1841. He said, "Many individuals suddenly became rich. The golden bait hung temptingly out before the people, and one after the other, they rushed to the tulip marts like flies around a honeypot. Everyone imagined that the passion for tulips would last forever." Well, it didn't, did it? Next slide, thanks, Peter. And even in more recent times, back in the 1990s, a colleague of mine, Keith Turpie, who's a wonderful person, Keith and I were looking at the internet market, the .coms, and from the work that we had been doing, the research work we had been doing in a number of areas, over several years, we came to the conclusion that the market was going to burst, the bubble was going to burst in those .coms. And I'd been in and out of a couple of stockbroking firms offering advice on a number of, providing advice and consulting in a number of areas and on IPOs. And we became convinced that, as I said, the market was going to burst. Between 1995 and the peak in March 2000, the NASDAQ Composite Stock Market Index rose 400%. But by October 2002, it had given up all of its gains that it made during the bubble. And when it crashed, it left, as you know, many companies destitute. It closed hundreds of businesses, etc. So once again, I guess the point is this: if things look too good to be true, an investment looks too good to be true, it probably is. We've had other examples in Australia. We had the Poseidon nickel boom, of which my own father put money into, and the price of nickel went dramatically up, 200-300 times its initial price before crashing back down again. And those nickel mining companies, many of them went into receivership and collapsed. Next slide, Peter. So that's one aspect of this. It's the investment aspect. Is it a good investment? Well, there's lots of people in lots of communities around Melbourne at the moment. Lots of advisors are saying to their clients, you should put money into crypto. Is it a good investment? Well, if you're taking out I wouldn't take out a second mortgage on your house and buy a whole lot of crypto. It's as simple as that. But this more fundamental issue here for many financial advisors, and a lot of them are actually taking instruction from their clients and putting lots of money into crypto through their SMSFs. Now, the thing about an SMSF, to remind you, and I'm sure you all know this, but it's good to remember that an SMSF is a type of trust. And it's important that clients seek professional advice, as the ATO website says. Remember, if it's a trust, you have to comply with, if you're putting money into an SMSF, there are various pieces of legislation that you have to comply with. The SISA, the Superannuation Industry Supervision Act, the Corporations Law, the Income Tax Assessment Act, but also, and people often forget about this, the trustee acts that apply in your state, because it's a type of trust. It doesn't negate or wipe out that responsibility to comply with those trust acts. If you're a member of an SMSF, you're a trustee of a trust and therefore subject to all relevant legislation. I know some of you were involved in the research we did a couple of years ago now. A few years ago, we did a national survey of people, over 1,000 people in Australia. And we asked people whether they had an SMSF. A whole lot of people put their hand up and said on the survey, yes, we've got an SMSF. And then we asked them, the next question was, are you a trustee of a trust? And about half the people who said they had an SMSF said they weren't a trustee of a trust or a member of a trust or anything else. So clearly there's a gap in people's understanding here. So aside from the legislation, trusts are created under common law and property law, and the trustee needs to be able to process the assets to be put in the trust. But the questions are to you, for you to think about, how do you possess and control crypto? As all you have is a contract without any intrinsic value. How do you secure crypto when it's held in space, in the cloud, as ones and zeros? And then how do you access and retrieve its value? So ponder those questions and have a think about them next time your client comes in and says, I want to put a whole lot of money into my SMSF, into crypto. Just hit the next page. Thanks, Peter. In Victoria, we have the Trustee Act 1958, and it deals with trustees' duties. And similar legislation's in place in all the states in Australia. So if you hit the next one, Peter. Now have a look at the trustee. Next time your client comes in, wants to put money into crypto in their SMSF, please read sections 4 through 9 of the Trustee Act in Victoria, if you're in Victoria, or the applicable legislation in your state. As it says there, section 4 says, the provisions that follow apply to trusts created before or after the commencement of Section 4 of the Trustees and Trustee Companies Amendment Act. So it applies to all trusts, in other words. Section 5 deals with investments. It says a trustee may, unless expressly prohibited by the investment creating the trust, invest trust funds in any form of investment. So you can put money into any form of investment. But should you? Next slide, Peter. Thanks. So here's these next provisions, these next sections are where the rubber hits the road. It says in 6A, it says, if the trustee's profession, business or employment is or includes acting as a trustee or investing money on behalf of other persons, exercise the care, due diligence and skill that a prudent person engaged in that profession, business or employment would exercise in managing the affairs of other persons, or B, if the trustee is not engaged in such profession, business or employment, exercise the care, diligence and skill that a prudent person would exercise. In other words, what they're saying here is, if you're a professional advisor, which many of you are today, you need to actually exercise a greater care of skill and due diligence and care when you're advising clients on these matters. So flip to the next one, Peter. And here it is. 7.1 says, any rules and principles of law or equity that impose a duty on a trustee exercising a power of investment continue to apply. And then section 2 says, part 2 says, without limiting the generality of subsection 1, a duty imposed by any rules and principles of law or equity include a duty to exercise powers of a trustee in the best interest. So is investing in crypto in the best interest of the client, of all present and future beneficiaries? So is investing in crypto the right thing? Are you acting in the best interest of the client and the beneficiaries of the trust? B says a duty to invest trust funds in investments that are not speculative. Is crypto speculative? I would think most people would argue yes. C says a duty to act impartially towards beneficiaries and between different classes of beneficiaries. And D says a duty to take advice. Well, you're the advice giver to your client who's come to you with their SMSF. And next one, Peter. And 8 says, matters to which trustees must have regard in exercising the power of investment. The trustee must, so far as they are appropriate to the circumstances of the trust, have regard to the purpose of the trust. So what's the purpose of the SMSF? Section 66 says, of the SISA, says it's to provide for retirement, isn't it? So the purpose of the trust. B says the desirability of diversifying trust investments. C says the nature and the risk associated with existing trust investments and trust property. How risky is crypto? The need to maintain the real value of capital or income. Okay, if it's a SMSF, you've got to maintain capital for retirement, don't you? E says the risk of capital or income loss of depreciation, and then the potential for capital appreciation. My point is this, okay, you need to be aware of these things. I can't tell you the right or wrong for any particular SMSF, but as the advisor, you need to be able to clearly articulate to the client that these are the things they need to consider as trustee of a trust, because that's what they are if they have an SMSF. And you as the professional advisor have a responsibility to ensure that they understand what they're doing and not simply say you're acting on their advice, because you know full well now under the PASEA code, you can't do that anymore, can you? I'll let you ponder these things and I'll come back at the very end of this. But we're now going to move on to Karen, who's going to talk a little bit about the work that she's been doing, particularly on taxation of crypto and different digital assets. I'll leave it to you, Karen.
Thanks. Thanks everyone for having me today. I'm Karen Powell. I'm a senior lecturer at the law school at Deakin. And just for a bit of context, I'm a lawyer by training, and I spent 15 years in practice in the United States before moving into academia. And I've taught tax law in both the United States and Australia, and I've been here for about 5 years. My expertise is in regulatory litigation. So I spent 8.5 years as a tax judge, and we wrestled quite a bit with definitions of property and transactions for tax purposes. And that really spurred an interest in intangible property for me, and by extension, crypto and digital currencies. But I also served as a state securities regulator for a number of years, and I find the parallels in securities to be quite parallel to what we're thinking about when we talk about regulation of digital currencies. So for example, Adam noted that there's no physical presence to digital currency, but that's actually now true for most of your banking and investments, your superannuation. I mean, we rarely see a tangible securities certificate. Very few of us would be holding our securities in a safe, in our house. So I think we have to think even broader than that. And I wrote a paper on definitional structures in digital currency with my co-author, Monica Hope, in 2019. And it's surprising to me how long or how much change we've seen in the regulatory schemes of digital currencies, even in that sort of 3-year period. And we're in the midst of following up this paper and writing about the current regulatory landscape. So the paper and the work that I've done is quite comparative. So it looks at the US and Australia regulatory frameworks. And I think for you all, it's also really important to consider that comparative work, different jurisdictions looking outside of Australia, is particularly important when we think about digital currency. As highlighted by both of my colleagues earlier, digital currencies are specifically not tied to a particular jurisdictional regulatory framework. So it doesn't matter if you're in Australia or the United States or the EU or Singapore. It doesn't matter where your location is. So next slide, please, Peter. And I want to speak a little bit to that idea of the digital economy and its effect on digital assets and digital currency. So there's been a lot of talk over the last maybe couple of years, maybe even a decade, on the digital economy, right? What is the digital economy? And I would say that the digital economy is now just the economy. Digital assets are a huge part of our global ecosystem. And you can see a few of the older numbers on the screen that digital assets are a huge amount of the general assets in the world. In fact, if you look at current corporations, they invest much more heavily into digital assets than they do into their tangible assets. So their intangible assets like software, people, all of that is, their investment is rising, while their investment in tangible technologies like old factories, right? Those are all depreciating and being eliminated. So how does that relate to what we're talking about here today? Well, in our 2019 paper, we argued that digital currencies were designed in most part to actually circumnavigate the reach of regulatory bodies, and therefore regulators needed to be particularly nimble in regulating that digital currency. And we argued for a more proactive approach in light of the global marketplace. And we focused quite a bit on about Bitcoin, as well as, as it's one of the most well-known digital currencies. And it has some great advantages, right? Low transfer fees when transferring it in and out of government-backed currencies, no cross-border transfer fees. So again, if you need to pay someone in Amsterdam or Paris, it doesn't matter. You don't have to worry about cross-jurisdictional issues. But what I think is important to think about in terms of addition to what my colleagues have talked about before is that Bitcoin and other digital currencies have moved into the mainstream. So we're moving from an emerging market to a stabilized market. And we're not at a stabilized market yet, but we are moving in that direction. For example, I don't know if you know, but a few years ago, EY was offering salary payments in Bitcoin. Advantages and disadvantages to that maybe. Peter, next slide, please. No need, if you can't see this on your screen, no need to think about it too seriously, but I want you to spend a moment, if you can, thinking about the tax and securities regulatory structures for convertible digital currencies in Australia and the US. So our banking and payment systems raised a lot of anti-money laundering issues as there was an emerging use of digital currency. And so the history of those anti-money laundering issues affect the emerging use of digital currency by everyday consumers. So as you can see on the slide, there's actually a huge variety of regulators overseeing digital currency. They're not in alignment with each other. There's no overarching regulatory approach, either domestically here in Australia or anywhere else, or internationally. So the essence is we have a lot of regulators with different definitions, and that deeply affects how we manage these types of digital currencies. So next slide, please, Peter. So what are we talking about here? I've got a bit of a comparison between the ATO and the IRS, so our tax regulators and how we treat digital currency in 2 jurisdictions. I've also listed ASIC and the SEC. So that is what is the securities industry regulators looking at when they're regulating digital currencies. So intangible assets are used as investment products, and they have been for a long time, right? So it's a natural fit or a somewhat natural fit that digital currencies would be classified in parallel to those intangible assets used as investment products. So a natural fit for the securities industry to regulate, natural fit for the tax regulators to want to make sure that they're capturing proper benefits that taxpayers have generated from the buying and selling of cryptocurrency. So while there are certainly aspects of regulatory avoidance and evasion, people who aren't, are in the emerging markets or they're not actually paying their taxes, they're outside of our regulatory system. The digital currencies, when they move into the mainstream, bring their own problems. They've been highlighted to you earlier, and I want to talk a little bit about the problems that we see in multiple jurisdictions. So we can look at the regulatory structure and definitional frameworks for digital assets. And the importance there is the inconsistency across domestic and regulation systems. So I'm going to give you a few examples, and then I'll tell you why do we care, right? So maybe this sounds so theoretical. Who cares if we don't have definitions that match in different jurisdictions? So, for example, the US SEC, which is their securities regulator, considers crypto assets as a security, but the Commodities Future Trading Company considers them as a commodity. The IRS considers crypto assets as closer to property for purposes of taxation. So now you have 3 regulators, all regulating digital currencies, all in different ways, right? That's one example of how the same jurisdiction, right? The US government at a national level is defining the same asset in 3 different ways. So in Australia, there's a few less layers of regulatory compliance. But for an example, unexpected regulatory issues occurred when digital currency was first defined as an intangible asset for tax purposes. So 2014, the ATO said, for tax purposes, digital currency, treat it like an intangible asset. You buy it, you sell it, you pay tax as if you've bought and sold an intangible asset. Well, that triggered some huge GST considerations. So the moment that you transferred digital assets, you were subject, or in general, subject if you were the last person in a transaction, to paying GST, which then nobody did. And the ATO had to rethink, and they shifted their regulatory posture to consider digital currency instead as essentially a capital asset for capital gains tax purposes. And that's to manage that GST function. So sure, from an academic perspective, that was an interesting regulatory shift. But as a practical matter, I'd like to flag for you how you might manage such change when you're managing or reporting assets for your clients, right? So for a couple of years, you've defined an asset as an intangible asset on your books, maybe for valuation purposes, maybe for tax purposes. And all of a sudden, there's a massive shift, and all of a sudden, that asset, which is wildly fluctuating anyway, is now considered a different type of asset for managing and reporting purposes. That causes huge compliance issues. And that's a huge and particular challenge for those wishing to use digital currencies in what I would call a stabilized market. So for people who are willing to report, or companies who are willing to report, they report it one way, changes, they have to report it another way. And this is happening in every jurisdiction. So when the reporting standards change every time, you have to think about how the fluctuation in assets needs to be tracked for regulatory purposes. So I don't want to bang on too long about this, but from a regulatory perspective, we then want to think about, do we define digital assets or digital currency in a very specific way, or do we want to use a more broad definition? So we think about specificity versus broad definitions, or principles versus guidelines. And we don't have the time, and you probably don't have the inclination to explore the legal theories that talk about the benefits and disadvantages. But I want to flag one issue for you before we move to the next slide. And that's the idea that the securities definition in the United States, developed in the 1920s maybe, used a very broad judicial definition of an investment contract, and it was called the Howey definition. And the definition is broad enough to incorporate any type of new scheme that's designed to circumnavigate regulatory systems. So the Howey definition, which has been around now for 100+ years, still functions to capture new products. And the Howey definition actually encompasses digital currencies, which is pretty interesting. So there are ways for us to regulate strategically when jurisdictions are willing to put their minds to it. So next slide, please. Peter? Oh, there we go. Okay, a lot of little blurbs up on this particular slide. So now what? Where are we now? In October of 2021, Australian Senate Select Committee on Australia as a Technology and Financial Center put out a very interesting final report. I recommend it to you for your reading. It encapsulates a number of the concerns that I've talked about, and some additional ones around what do we do with regulating digital currency. And the recommendations included a type of custody or depository regime, right? So that would be like a central authority so that we can track this. Again, I think there's advantages and disadvantages to that. But I want to give you just one more pragmatic example that flips around our thinking for digital cryptocurrencies from a regulatory perspective. By that, I mean, let's see what's happened in the real world, and figure out if our broad-based discussions about how we regulate this amorphous product makes any sense. So in September of 2021, El Salvador included Bitcoin as its official currency, right? And it was, in fact, and still is, issuing Bitcoin to its citizens as an incentive for using digital banking. So why do we care about this? Well, in all of the past definitions, for most countries, they've said that digital currency is something other than money, right? It's something other than currency. It's something other than foreign currency. But now El Salvador has essentially made Bitcoin foreign currency under law. So little tiny El Salvador last year blew up most definitions, almost every definition of Bitcoin as a digital currency. So how does that now change our views of regulatory compliance? Are we going to treat all Bitcoin as foreign currency? If so, the reporting requirements for every single one of your clients in Australia now become quite clear, but also a big hassle. How do we wrestle with the conflicts of laws issue? So which jurisdictional definition is correct? If we've defined it not as money, but it is absolutely now money, do all the other digital currency definitions go out the window? Can consumers and your clients elect to treat Bitcoin as foreign currency? This goes back to Peter's discussion of our central authority. Our international legal system allows us to designate a domestic central authority to recognize foreign transactions or money. So the crypto endeavor is not going particularly well in El Salvador, but that doesn't matter. It's still defined as foreign currency under law. So now what? Next slide, please. I've just got 3 more, and I'll buzz through them quite quickly so we can get to a few questions. So my co-authors and I are exploring what we can learn from historical regulation. And I just want to make, let's say, one final point. So securities regulators have been faced with regulatory challenges of new products since the inception of regulatory structures. The creation of the US SEC, the Australian Securities Regulatory Systems, which has changed names and formats a number of times, was fundamentally based on cross-border regulatory capture of investment schemes that were attempting to evade regulation, right? They were the first intangible asset that regulators tried to manage in the same way that we're trying to manage digital assets now. Now, as I might have mentioned earlier, securities regulation started in the US at a state level, where various shysters were out selling schemes to ordinary investors. A little bit of parallel to what Adam was talking about earlier. And those criminals would just move from jurisdiction to jurisdiction to avoid regulation, selling an intangible asset. And that triggered states to broadly regulate securities as a matter of consumer protection. But because the state laws were too inconsistent across borders to effectively regulate, does this sound familiar? It should sound like our regulatory structure of digital assets. The federal securities regulation came in place to build on the premise of disclosure, right? We don't have time to cover all of that today, and there are some problems when our securities law and our tax regulators differ. But I want to flag for you that regulatory structures are likely to fail if they're not properly covering the scope of the market. So next slide, please. So just a quick reminder, of where we are. This might be a question of internationalization, sovereign jurisdictions versus globalism, which is more like sovereign states. And we're looking for a definitional structure that can preserve both of those. And so we've suggested one here. which is essentially when we move from an emerging to a stabilized market, we need increasing information for consumers. We need classification by regulators that recognizes the broad nature of digital assets and recognizes the shifting landscape, as well as collaborating across domestic regulation, as well as international regulatory schemes. Because digital currency acts both outside of and within our regulatory markets, and we might as well recognize that factor. So next slide. I just want to leave you with a few thoughts. Federal securities regulation came in based on the premise of disclosures, and we might want to think about that in the future. Is that the last slide? I think we might have one more. Yeah. So we're expected to manage compliance in a vastly different way now than we did when securities laws first came into place. I mean, just consider the reporting requirements when a digital asset changes regulatory compliance mechanisms, right? Tax, securities, commodities. It's a huge pain for consumers. It's fascinating, it's complex, and it challenges our way of thinking. And I would challenge you to come up with the ultimate regulatory structure. So thanks for listening to me today, and happy to field some questions.
Before we do, we're just going to pass them to Adam just to wrap up really quickly.
Yep, thank you very, very much. Look, just to let you know, these webinars, we run them for free. We organise them on topics that we think are interesting to the profession and to those who provide professional financial advice. Note that we're still running as normal. We're still running our graduate certificate, graduate diploma, and Masters of Financial Planning. We're still offering bridging units for those of you who want to continue and complete those. For those of you who want to transition your career into financial planning and financial advice, we offer you those range of courses. We're continuing to run our intensives, and particularly the intensives in ethics and financial services regulations, and also in behavioural finance. So you can find details of those. You can contact us through the financial planning group, or contact Peter or myself directly, or Mark Olnick directly, or through the financial planning email address that you would have received when you registered for this event. So look, I just want to thank, we are out of time, unfortunately. I want to thank Peter and Karen for their organising of this and their participation in this. Note that my comments are not to a counter to anything that Peter and Karen said, but simply to say, if investments look too good to be true, then they usually are. And there is no quick way to get rich other than through hard work and endeavour and effort. And for those people who try historically have come undone. And please, if you are advising clients on SMSFs, be aware of the legislation and aware of the regulations when you actually offer your advice. That's all I've got to say. Thank you for coming.